Lululemon, the company that makes your yoga pants and your running shorts. What if you invested in it? Right now, just $1,000. So, here's the question. Could that investment turn into tens of thousands or more? One day, one stock. Today, we'll look into Lululemon. Welcome to Stock Snack. All kind of financial numbers could be overwhelming. At Stock Snack, we help to analyze stock, if they are good or bad. At Stock Snack, we help justify it and present it to you, fast and joy, like having snack. So, we're going to break this down into 4 parts. It's a step-by-step process. First, we'll look at the company. Just the basics. Who are they? What are they selling? And who do they compete with? Next, we'll dive into their business segments. You see, this helps us understand where their money comes from. Then, we'll get into the financials. A checklist. Are they healthy? Are they stable? The numbers will tell the story. And finally, we'll talk about the price. Is the stock a bargain or not? We'll look at the projections, and you can decide for yourself. First, the business model. It's all about premium activewear. Lululemon sells it directly to you, the consumer. This helps them build a community, a really loyal following. And where did it all start? Vancouver, Canada. Back in 1998, that's when the founder, Chip Wilson, started the company. Then, a few years later, in 2000, the first store opened, also in Vancouver. And then, a big moment. They went public. The IPO, that was in July of 2007. A few years later, in 2013, the founder, Chip Wilson, he resigned as chairman. After some controversy, then in 2023, they were officially added to the S&P 500 index. That was a big milestone. So, where are they now? They're global. You can find their stores in 29 different countries. They're not just a small brand anymore. They're a big player in the apparel industry, especially in activewear and luxury goods. And what are they selling the most of? It's pretty simple. Number 1 is women's apparel, then men's, then accessories. After that comes footwear, and then some other stuff. It's mostly a D2C model, direct to consumer. So, let's talk about the competition. It's a crowded market. We've got 2 groups to look at. First, the big global players, the giants of the industry. Number 1 is LVMH. They're huge. Luxury fashion. Leather goods. They're in a whole different league. Next is Nike. You know Nike, footwear, athletic apparel. They're a massive competitor. And then there's Zara fast fashion, always on trend. Adidas is another one, just like Nike, athletic footwear. And Kering is on the list. Another big luxury group, lots of high-end brands. Now, for the second group, the direct competitors, the ones doing exactly what Lululemon does. Number 1 is On Holding. They make running shoes and apparel. Then you have Hoka. They're known for their running shoes, the maximalist style, really thick soles. Athleta is another one. They're owned by Gap. They focus on women's activewear. And there's Alo Yoga. You see them everywhere. They're huge in the yoga space and activewear. Finally, Vori. They're a newer player. Performance, lifestyle apparel. All of these companies, they're all fighting for the same customer, the same market share. So, let's talk about the brand itself. Is it strong? Is it respected? Well, we looked at a few different reports from companies that rank brands like Brand Finance and Interbrand and Cantor Brand Z, and the results were pretty clear. Lululemon's brand value is huge. It's grown a lot. Just in the last few years, it's now ranked among the top 100 brands globally. That's a big deal, and it's in the top 10 for its industry. The management team, they're a big reason for this success. They've been consistent with their strategy and their execution. So, where is the company going? They're expanding, they're going global, and they're focusing on men, the men's category, and they're innovating with things like footwear. They want to be a head-to-toe brand. For everyone, their competitive advantage, it's all about 2 things. First, technical innovation. Their products are really high quality. And second, that community. That loyal community they've built, it's their secret weapon. And the industry trend, it's all moving in their direction. People want versatile clothes. For performance, for comfort, for everyday style, the athleisure trend is huge, and Lululemon is right at the center of it. Okay, Let's look at the numbers, revenue, and how it's changed. We're breaking this down by a few things. First, by channel, where they sell their products, their company-owned stores. The revenue there has grown. From 2015 to 2024, it's been a solid increase, but they're direct-to-consumer business. That's the real story. Online sales, things like that. That revenue exploded. It grew by over 30% per year, a huge number, much faster than inflation. It shows that people are buying directly, not just in the stores. Now let's look at it by region. The Americas, that's their home base. That revenue is also up. But the international market, that's where the explosive growth is. Revenue in other countries, it's grown by almost 40% a year. That tells you something. They're expanding globally, and it's working. Finally, by category, women's apparel. It's still their biggest business. The revenue there has grown, but the real growth driver, the men's category. That revenue grew by over 25% a year. It's catching up. It shows they're not just a women's brand anymore. They're making a big push into the men's market, and it's paying off. Let's talk about the future. And the numbers, we're looking 10 years out, from 2024 to 2034. So, what are the projections? How much could you make? First, let's look at the benchmarks, the S&P 500. Over 10 years, if you put in $1,000, that would turn into about $3,000. That's a pretty good return. Then there's the NASDAQ 100, the QQQ, same idea, $1,000. That could turn into about $5,000. Now, let's compare that to Lululemon. We used a few different methods. One method, based on cash flow, it's a big number. It projects that $1,000 could turn into over $85,000. That's huge. Another method, using EBITDA, it's more conservative, but still massive. That same $1,000 could become over $35,000. So, if you average all the methods, the projected return is still incredible. That $1,000 could turn into over $60,000. That's a massive gain. When you look at the S&P 500, or the NASDAQ, it's on a whole different level. The numbers suggest this stock has some serious potential. Let's talk about the financials. We've been through the annual reports, the balance sheet, the income statement, and the cash flow statement. We analyzed multiple metrics for each one to see if the company is healthy. We'll discuss the details later. Right now, we're just providing an overview to get some top-line insights before we deep dive. So, here's a quick look. The balance sheet, the latest numbers, 5 out of 6 metrics look good. That's an 83.3% score. That's a good score. And over the last 10 years, 4 out of 5 metrics look good. An 80% score, also good. The income statement, it's a little different for both the latest numbers and the 10-year average. 5 out of 8 metrics look good. That's a 62.5% score, below our 70% benchmark. So, we gave it a bad score. And the cash flow statement, it's the weakest. Just 1 out of 4 metrics look good, a 25% score. That's a bad score. The 10-year average, 2 out of 6 metrics look good, a 33.3% score. Also bad. So the overall picture, it's a bit mixed. The balance sheet is solid. The others, not so much. But let's look at the bigger picture. The key attributes, revenue growth, it's 19.94%. That's a lot. The benchmark, just 6.16%. So that's a good score. EBITDA growth, it's 23.82%. Also a good score. And free cash flow, it grew by 29.47%. Another good score, the company's debt. It's low. The debt to EBITDA is just 51.47%. Our benchmark is below 300%, so that's a good score. And the price of the stock, our projection shows a 50.8% return. The benchmark, like the NASDAQ 100, is 19.86%. So the stock is well priced, and it gets a good score. So while some of the financials look weak, the key growth drivers are very strong, and that's the most important part. All right, so let's look at the first method. We're projecting the price based on FCFE, that stands for free cash flow to equity. So first, we project it. For the next 10 years, we use things like operating cash flow and CapEx, and also debt. Then we take that projected number And we get the FCFE per share. We just divide it by the total shares. The shares we project for 10 years from now. After that, we estimate the FCFE yield. We use a weighted average. You see, we give more weight to the latest values and also to the smallest values. Then we find the estimated stock price using that FCFE per share and the FCFE yield. This shows what investors might pay for the company's free cash flow. And finally, we figure out the total return. We add in the dividends. The dividends received over 10 years, because that's all the actual gain. Now, the next method, based on EBITDA first, we project the EBITDA for 10 years. We use a 10-year average growth rate, with more weight on the latest numbers. Then we estimate the EV/EBITDA yield. This gives us a sense of something, how much a buyer would pay for the company's earnings. After that, we get the projected enterprise value. We multiply the projected EBITDA by the EV/EBITDA then. We find the EV market cap ratio using a simple average, and we multiply that number with our projected enterprise value to get the projected market cap. Then we divide it all by the total shares. That gives us the projected price. And again, we add in the dividends to get the full projected return. And for the third method, this one is based on dividend yield. Because Lululemon, there is no dividend. So we won't be going into that part. Okay, so let's look at the balance sheet. We have a checklist with 7 metrics. First, cash to debt. This shows if a company can pay its debt with its cash. The benchmark for us, we want that number to be greater than 1. Lululemon's latest report, the number is 2.52. The company has more cash than debt, and the 10-year average is even better, 3.39. So this one gets a good score. Next, debt to equity. The benchmark for us is below 80%. This shows if a company is using more debt or more of its own money to fund itself. The latest report shows 36.45%, and the 10-year average is 28.06%. Both are well below the benchmark. So, another good score. Next is preferred stock. A company with preferred stock. That means they needed to find other ways to raise money. A healthy company won't have it. Lululemon has 0, so that's a good score. Now, retained earnings. This shows a company's ability to grow. The compound annual growth rate, it's 16.75%. That's strong growth, especially during a recession. So that's a good score. But there is one bad thing, treasury stock. This is the amount of shares the company has bought back. Lululemon has a 0. This is a red flag for us, because it means they aren't actively buying back shares, which can be a sign of poor management of capital. So that's a bad score. But let's look at 2 more things. Return on equity row. The benchmark for us is above 25%. It shows how well a company uses its own money to make a profit. The latest number is 41.98%. That's a good score. And the 10-year average is 32.51%. Also a good score. And finally, return on total assets. ROTA, the benchmark, is above 10%. This shows how well they use their assets to make a profit. The latest number is 24.42%, and the 10-year average is 20.33%. Both are well above the benchmark. So those are both good scores. Overall, the balance sheet is in great shape. That one bad score, it's something to watch, but the rest looks really solid. Okay, so let's look at the cash flow statement and how the money moves. We have a checklist with 8 things we look at. First, gross profit to revenue. This shows a company's pricing power. Can they charge more for their product? The benchmark for us, it should be over 40%. Lululemon's latest report is 59.23%, and the 10-year average is 55.01%. Both are well above the benchmark. So that's a good sign. Next, SG&A to gross profit. This shows if the product sells itself without a lot of marketing spend. Our benchmark is below 30%. Lululemon's number is 59.99%, and the average is 61.37%. Both are too high. This gets a bad score. The product needs a lot of selling. Now for R&D to gross profit. This shows a simple business model. We want it to be below 30%. Lululemon's is 0%. They don't spend a lot on research, so that's a good score. Interest expense to operating income. This tells us about their debt. We want it to be below 15%. Lululemon's is 0%. That means they have very low debt, or they have no debt at all. This is a good score. But let's look at taxes. Income tax to pre-tax income. We want this to be around 20%. For credibility, Lululemon's is 29.54%, and the average is 30.18%. That's a bad score. It's higher than we want. Now, net income to revenue. This shows if they have a competitive advantage. Our benchmark is over 20%. Lululemon's is 17.14%. The average is 14.68%. Both are below the benchmark. So this is a bad score. Then net income per share. This shows consistent growth. We want a number above 0. Lululemon's latest is 14.64, and the 10-year average is 6.44. That's strong growth, a good score. And finally, debt to EBITDA. This shows the payback period for debt. We want it below 3. Lululemon's is 0.52, and the average is 0.51. They can pay back their debt fast. A very good score. So, we have some good scores and some bad scores. Overall, the picture is mixed. Let's dive into the cash flow and a few more metrics. First, stock-based compensation. This is when a company pays its employees with stock, not cash. We want this to be less than 30% of revenue, or 10% if growth is slow. Lululemon's latest is just 0.85%, and the 10-year average is 0.95%. Both are really low. That's a good score. It means they aren't diluting shareholders. They're not giving away too much stock. Next, we compare cash flow to net income. We want operating cash flow to be higher. We want more cash coming in than what the income statement says. But Lululemon's latest number is 0.8, and the average is 0.75. This shows their earnings. They aren't as strong as they look. Now, let's talk about growth. We compare free cash flow growth to net income growth. We want free cash flow to grow with net income. But here, it's not matching up. The latest ratio is 2.2. The average is 1.24. These are both bad scores. It shows the company has a high cash outflow. Now, for capital expenditures, CAPEX, this is what they spend on things like new stores or new equipment. We want this to be less than 25% of net income. Lululemon's latest number is 37.96%. The average is 45.65%. Both are too high. That's a bad score. It means they are spending a lot of cash. And finally, we look at dividends and buybacks compared to free cash flow. The benchmark is below 1. We want to see that money used for growth. Lululemon's latest number is 102.15%. That's over 1. So that's a bad score, but the 10-year average is 68.92%. Below the benchmark, so that's a good score. The latest numbers show they are using their cash on buybacks and dividends, more than on growth. It's a mixed bag. So, let's wrap this up. We've gone through everything. The qualitative part, the financial statements, and the price projections. So what's the verdict? First, the balance sheet. That looked good, very strong. The income statement, that was mixed. Some things were good, some were not. And the cash flow statement, that was our weakest link. It had some bad scores. But the price projection, that tells a different story. $1,000 could turn into tens of thousands, or more. The projections are huge, way above the market benchmarks. So what does it all mean? The company is financially healthy in some areas, not in others. But the key attributes, the growth, the value, they are all very good. And that makes this a stock worth taking a serious look at. It's a company with a strong brand and a lot of future potential.